Hey folks, what's going on? This is Shadow Stars bringing you another video today. This is going to be part two of my video in which I talk about some of the updates going on with AMC. This video is going to be focusing on the big news that hit, the bombshell that was dropped in regards to AMC's potential deal that's going with Antara Capital. Maybe I'm pronouncing it wrong. But let me give you a quick recap of what happened in part one. In part one, I discussed the financials of the company. I looked at the box office figures. I showed you the sources of a lot of my data. Pulled up the official SEC filings, the 10Q, and the consolidated figures that I pulled from the 10Qs, along with the consolidated info from Box Office Mojo. So a quick TLDR from that part one of the movie. I said that Q2 versus Q4, Q4 is going to be lagging behind Q2. Any way you split it. They're currently down $884 million versus Q2. Even if, I say best case scenario, if for the remaining 10 days of the year, box office wise, if they mimic Friday's performance when Avatar first came out, that's December 16th, Friday, of 57 million, even if it does it for 10 days, they would still be behind by $308 million versus Q2, meaning that Q4 would be around $2 billion box office. Domestic box office, $2 billion for Q4. So that's a little bit more than 10% under of Q2's figures, resulting in AMC having, once again, more cash burn for this quarter, more than Q2, less than Q3. The reason why I came to that conclusion is because box office is going to be slower Q4 versus Q2, meaning revenue is going to be less than Q2. They have fixed costs that really aren't going to decrease. Operating expenses, their rent, their depreciation costs, the depreciation calculations. Sure, film exhibition, food, beverage, obviously those will scale based on how many people buy tickets, concessions, etc. But nonetheless, they're going to have a net loss. I talk about their cash position and how, after looking at the debt covenants, we're looking at roughly $460 million liquidity cash that they can really use, because 100 needs to be kept on hand, and how at improved financial situation of approximately 20% by 2023, end of 2023, not quite to the end of the year, they would probably run out of money. That was all covered. I covered that aspect in part one of my video. So that's to help catch up, basically. Now, this part two video, is going to be covering this whole aspect. AMC announces that they raised an additional $110 million in equity capital, potentially another $100 million debt for equity exchange. But the conditions for that require a vote for APE to be converted into AMC shares, and for a reverse stock split of 10 to of changing 10 shares to 1 need to occur. So the board of directors are going to be holding a special shareholders meeting for those who own shares of AMC and APE. We know that APE has the same voting power as AMC, right? Common shares of AMC. It's a 1-to-1. So those are the three things that you need that'll be raised. You'd have to increase the authorized number of common shares so that APE could be converted back into AMC. Once that's approved, they'll do a reverse split of the common shares. AMC was trading in that anywhere from a $3 to a $4 range today. So for every 10 shares of AMC, after the reverse split, you'd have one. But this is the biggest thing, I think, that people need to pay attention to, is to adjust authorized ordinary share capital such that, after giving effect to the above proposals, if adopted, AMC would have the same ability to issue additional common equity as it currently has to issue additional APE units. Now remember, APE was something that was voted by shareholders many years ago. That's why without the current shareholders right now, without their approval, they were able to create this APE, have 516 plus million APE first created, and then they did another 425 APE, up to 425 APE to sell, offered, all without additional approval. So at this meeting, they're saying that, hey, vote to give AMC that ability to do it for the company. So because you're converting APE into AMC, that restricts their ability to raise cash. From a company standpoint, this totally makes sense. They don't want to be handicapped again by not being able to dilute. Previous shareholder meeting, when retail investors denied the company the ability to raise funds through dilution, the additional dilution, authorizing the additional shares, AMC had to go back to the little planning board, and figure out, hey, we need additional money. What can we do? They had to go back, I believe, as far back as a 2013 proposal that was voted on. They had to bring that up so that APE could be made. It's a smart thing by the company to do, but for the typical investor, retail investor, that's a pretty big kind of stab in the back. Because they had no clue that would happen. But let's look into the details of some of this. So the first part is that, hey, they were able to raise additional $110 million. So that improves their liquidity standpoint. $460 million, that bumps it up to $570 million. And we know that, hey, it'd be done in 2 tranches, weighted average price of 66 cents per share. So they got a killer deal. APE, I think, was trading over $1 today, so they got a massive deal. Second part, under the terms of the agreement, Antara is already a debt holder. They would exchange $100 million of the principal amount of these notes due in 2026 for 91 million APE units. So AMC raises additional $110 million in cash. They're able to reduce their debt by $100 million. And then factor in that, hey, their annual interest expense reduced by $10 million, provided if this agreement never happened. So this is all good in terms of the balance sheet of the company. You're raising more money, so you have more cash. You have less debt to worry about. And you have reduced interest expenses. So the first tranche that was immediately purchased, 60 million APE units, is through the at the market program. So that 106, the remaining, so it's like 166.6 million APE. 60 they immediately get. The second half of 106.6 would be subject to the completion of the waiting period. But this needs to occur. There's going to be a special shareholders meeting, I believe within 90 days. I need to double check this. This is the official SEC filing. Where did it go? Yeah, pursuant to the forward purchase agreement, the company will hold a special meeting of its stockholders within 90 days of the date of the agreement for a vote. So they need to increase the number of authorized common shares of AMC so that they can convert APE into AMC. Then they're going to do a reverse split of 1 to 10. So every 10 shares of AMC would now be 1. And this is the biggest part, is to adjust the authorized ordinary share capital so that if these two proposals are approved, AMC would have the same ability to issue additional common equity as it currently has to issue additional APE. So APE, we know that, hey, this was not approved by basically the current group of folks that own AMC. This was a proposal, if I recall correctly, back from like 2013 or something. And that's what allowed AMC to create 560 million shares of APE initially. Every 1 share of AMC equals 1 share of APE. And then they were able to do again without additional shareholder approval, up to 425 million APE, more APE. And remember, they still have several hundreds of millions of, actually almost like billions of APE left that they could sell. Because I think they had 40 million preferred shares, 40 something million preferred shares left. And each preferred share is worth 100 units. Nonetheless, it's been a little bit. That's not the biggest focus. The biggest focus is that, hey, they want to give AMC the same ability to issue additional common equity, just like APE. So they don't want that restriction of not being able to dilute. Previous round, when they had the shareholders meeting, shareholders voted, hey, no, we do not want you to dilute. We are not authorizing more shares. And that's why APE had to be made. Well, if now they get rid of APE, convert it all back into AMC, they're saying, hey, we can't have this restriction of not being able to dilute AMC. From a company standpoint, it's a smart move. From a financial aspect, because AMC needs more money. We did the calculation of, hey, they had if a cash burn of $120 million a quarter, AMC would run out of money before the end of 2023. That $120 million is a 20% reduction from, on average, of 2022 figures, where it's nearly $150 million cash burn. We're saying that they're able to reduce their cash burn by 20% year over year, which is a great improvement, 20%. But that wouldn't be enough to last them full 2023. This additional capital raised, how does that change the equation? So, divided by 120 million. That gives them a full 2023 and through more than half of 2024. If 2024 is an improvement on 2023, obviously the cash burn would be less. So maybe that gives them until 2025 without any additional dilution. But nonetheless, they don't want to be handicapped. So this is a smart move on behalf of the company. But for the shareholders, this is a risk. The risk is if you don't authorize the company to raise more money. So let's say this deal doesn't go through. Well, then they're not able to get in this fresh injection of more capital. They're not able to reduce their interest payments, their annual interest payments, by $10 million a year. They don't take off that $100 million debt off the books. That puts them in a situation where, hey, 460 million. If that 110 million sticks, I have to carefully read this again. Let's see. The forward purchase agreement is subject to the satisfaction of certain closing conditions. AKA, they have to sell nearly 106.6 million, ape for 75.1 million, and the principal amount of that 100 million that they already own of the lien notes 2026 for 91 million ape. So, but prior to the agreement, they already bought 60 million ape for nearly $35 million. So the thing is this. This purchase agreement that they entered into wouldn't occur. I doubt this would occur without them being confident in the ability for the votes to go their way. Sure, it could. There are some very small percentage of transactions where these agreements fall through, but most of the time, these agreements go through, and they're only placed forward when they think they have the votes. Why would you spend all this time, all this money, all this energy to put forward an agreement to hold a vote if you didn't think you had the numbers to win it? So I think this is nearly a done deal. We're just waiting for the final signatures, basically. Follow the regulations. Make sure all the I's are dotted, T's are crossed. All the periods are there. Wait for the ink to dry. But this is going to go through. So this greatly helps the company in a financial aspect. You've now basically taken off potential bankruptcy for 2023. Provided that the theaters, the box office industry continues to improve in 2023, which you would hope. More releases should be coming down the pipeline in 2023. But is it enough of an improvement? The liquidity, the cash liquidity and the stability might be there for next year. But the question comes down to always, for me, is there debt? It doesn't do you any good of just surviving 2023, 2024, 2025. You have a massive debt payments in 2026. How are you going to be able to pay for all that debt? How are you going to finance all that debt? Are you going to be able to refinance it? These types of transactions help. You're bringing in $110 million new. You reduce your debt by $100 million. And you reduce your interest payments. Because a lot of this is basically sandbagging the company. you look at it that, hey, if you just look at AMC's total revenue, based it on their top four costs: film exhibition cost, food and beverage cost, operating expenses, and rent. Does total revenue cover those? You want that figure to improve. If they didn't have such large interest payments and corporate borrowings, the company wouldn't be burning as much cash. And because they sit on several $100 million of cash on hand and cash equivalents, they're able to weather the storm. So you need to find a way to reduce your outstanding debt. You need to find a way to reduce the interest payments that you need to make. But at some point, you still need to pay that principal. You still need to pay back that debt. You don't have an infinite reprieve on that debt. It's no different from when you buy a car. You buy a $30,000 car. It does you no good if you're only paying enough to pay the interest on that amount. If you're not able to pay the principal amount. If you're only paying interest on it, soon you'll reach terms where, hey, that debt needs to be fully paid. $3 billion needs to be fully paid 2026. How are they going to pay for that if all they can do is just survive 2023, 2024? They need to turn a profit so they can pay that back. And so that's why I think that, hey, you know what? This is a smart move by the company to stave off any liquidity or bankruptcy issues for the time being. But significantly more work needs to be done because financially this company is still on shaky grounds. Now I'm sure a lot of people are saying, hey, this portion is pretty bad because, hey, it could dilute our shares. Most definitely. This clause is going to be used, I'm sure soon in the future, because as I mentioned, they need to raise money. If theaters don't do well, if a movie has terrible showings, if a film absolutely tanks, less people are going to go, meaning less people are going to be spending money at the concession stands, less people are going to be buying merchandise, etc. That means that their liquidity is in danger. So they need that buffer. There's a reason why they were holding on to billions of dollars of cash, and as opposed to for them just immediately spending that money to buy back their debt. Because you need a buffer in case something else happens. So my thought is, once again, I'll reiterate that this is a good idea in terms of the company. It helps their financial situation. But for the folks who are hoping for some sort of short squeeze, this is terrible. Because this is a method in which this does nothing to alleviate the current short thesis of poorly performing theaters. Especially in the case of a reverse split, companies that do reverse splits do not tend to do very well. The price goes back high, so it'll go up tenfold because it's doing a 10-to-1. And they'll take that opportunity to short the company again. As opposed to shorting a company from $4, they'll short the company from $40. And you know that more dilution is in the works because they need more money. They need to have more money on hand. So the value of your shares, sure, the number of shares will change. The overall value initially will not change. But as more dilution comes through, which will be authorized when this proposal is voted on and approved, if your share was worth $4 pre-reverse split and it's worth $40 after the reverse split, when they do dilution, it's going to be not 40, it'll be less. Maybe it'll be 36, 34, 30. And until AMC can demonstrate the ability that, hey, you know what? Our cash on hand and our cash burn, it's not a problem for us. We're going to be generating a net profit versus a net loss. Until that point comes, this company will continue to suffer from those who short it. But it's not folks that are malicious. It's just simple math, simple finance. This is a company that has $5 billion plus debt. They have billions of dollars of debt, but it's a company that cannot seem to generate profits quarter after quarter. It's burning hundreds of millions of dollars every quarter. It's not a surprise that a company has debt. The surprising or the alarming portion is when a company has debt but no way to really pay off that debt because it's not turning a profit. If the company is turning $100 million, $200 million net profit every quarter, $5 billion, yes, the amount could be a lot, but it's not super concerning because, hey, the company turns profit. It has money it can spend consistently to pay off that debt. Creditors will not be so afraid that, hey, you know what? Is there a worry that this company won't be able to pay off my debt? But in the case of AMC, if the company is losing money every quarter, it's not able to generate a profit, it has a mountain of debt, then they're going to be afraid that, hey, you know what? The company might go bankrupt. I might not get my debt paid. So it's a risky business for lenders. Would you want to lend more money to a company that seems to have issues paying back its debt? Where their profitability model, their business model is not doing so well? So I applaud the efforts of the company to find additional revenue streams. It's good that they're making efforts to do that. The question becomes, is it going to be effective? Is it going to deliver results? That's all these people, all Wall Street cares about. Can you deliver profits? Will your profits meet projections and estimations of what analysts think? If it doesn't meet expectations, stock tanks. It exceeds it, your stock skyrockets. AMC has not been meeting expectations. It's a company that's not able to generate profits. I'll go back on the yearly. 2021, obviously, COVID hit. 2019, you don't have excuse of COVID, but you burned millions, 149 million. 2018, 110 million profit. But 2017, 487 mil burn. The company is burning millions of dollars. So for the short thesis to be dead is for the company to stop burning money quarter after quarter. So how can they do that? Either they pay down that debt by turning cash positive, or in some sense, do what they did with Antara. If they're a debt holder, give them a portion of the company. Hey, give us X amount or forgive us X amount of debt that you own of our company, and we'll give you a portion of our company. That way, hey, we don't have to spend millions of dollars of interest. That millions of dollars could be saved. That millions of dollars could be reinvested into the company to generate more money. But until that day comes, it remains risky. This company's financials are very poor. It's improving. That's good news, but will it improve in time? That's the important part. Will AMC be able to improve fast enough so that, hey, it's able to pay off its debt? Right now, it is struggling to survive. And we'll see if it's able to be successful. But all current signs show that, hey, you know what? It doesn't look good. But we never know what the future holds. We never knew a pandemic would hit. On the flip side, maybe we come out of a recession into a ridiculous bull market. We may never know. But based on current projections, current trajectory, it's looking bad. And that's why the company's stock price also seems to be tanking, not because of manipulation, not because of crime, but because the company's performing poorly. You think a company's stock price will go up when they're burning $337 million a quarter? Your revenue is $785 million, but your operating expenses, your costs, $952 million. On top of then the corporate borrowings you pay. When your assets is $10 million, but your liabilities, $10 billion, but your liabilities is $12.5 billion, more assets than liabilities. A flip from years ago where you had more assets than liabilities, i.e., look at 2017, 9.8 billion in assets, only 7.69 in liabilities. It's about reading financial statements, looking at the industry, looking at their business model. I don't think that movie theaters are going to completely disappear. But I think this company, AMC as a company, has a terrible business model with poor leadership in place. The company expanded far too much, had far too many underperforming theaters that they're not able to shed at a quick enough pace so that it can generate enough money. The situation with COVID exacerbated their situation. But even without COVID, it still wasn't doing that well. As I said, 2019, cash burn 149 million. 2017, 487 million burned. They were spending a ton of money without having the ways to really pay all that back in a decent enough time. They modeled too much growth without any room for error. And when the pandemic hit, they really got screwed even more. So, wrapping it up, I think this agreement, forward purchasing agreement by Antara, is going to happen. I don't think it would have been brought up if the votes weren't there. This is good for the finances of the company, but it's going to be terrible for shareholders, retail shareholders that didn't know better. Those people expecting a squeeze, you're in for a rude surprise. I'm There is going to be no short squeeze. The short squeeze already happened back last year when this went to $72. And for you to hope that it's going to go back and beyond those levels is absolutely hopium. I hope that you guys can learn something from this information I'm providing. SEC filings, 10Qs. Domestic box office gross from Box Office Mojo, IMDb Pro. Look at the numbers. These aren't fudged. These are from, I showed you the exact source of where I'm getting this information, where I'm getting this data. It's not lies. Facts are facts. Numbers don't lie. If you disagree, then show me. Show me the numbers. Show me how this can turn around. Show me, based on previous performance, some sort of logic and reasoning behind how this can turn around. Don't throw around random improvements, 50% improvement, 75% improvement. Don't show me that. Show me previously, or show me a previous company, a company that's shown that type of recovery or improvement in a similar industry. I doubt you'll find it, but maybe I'm wrong. But this is just my perspective. Based on the data that I've gathered, the data I see, this is the path I think it's going to go towards. Don't just think based on your emotions. Do it based on facts. Do it based on evidence. Solid facts from reputable sources. Not off of random people on Twitter. Not off of random people on Reddit. Official data sources, or sources you can trust and believe. But that's my video. Hope you folks learned something from this. I know it's very long. That's why I had to split it into 2 parts. Maybe I had to split these 2 videos into 2 additional parts and make it 4 parts. But once again, hope you folks enjoyed it. Hope you guys learned something from it. If there's any mistakes, please let me know. Any questions, leave them down below. I'm going to be holding a live stream over the weekend to cover any things that you'd want me to cover. I'd love to chat with people on both sides, people who agree with me, people who don't. I'd love to talk it out, see where you're coming from, how you got there, the logic and reasoning behind it. I don't want to talk to people who just do based on emotions. I want logical, reasonable people that are thinking, that can back up their talk with actual data and evidence, provide sources, and love to see how we got to this point. Nonetheless, this is Shadowstar signing out. Hope you guys have a good evening. Peace.